Welcome back to Cool Trade University. My name is Gene Guarino, and we're going to go into what we call Stock Market 202, kind of the next level. If you watched the Stock Market 101 video and training that we did, we talked about terms in the market and all the basics. Now we're going to take it to the next level and really talk more about Cool Trade itself and some of the philosophy behind how to use it. So when people get into the market, they kind of have a mentality, and their mentality very commonly is to simply buy and hold. So they choose a company and they invest for the long term. So that buy and hold mentality is all about, my investing in a company that's got good numbers, good earnings, and they get that information from the news, and they try to do research, and they watch TV shows and those type of things, and they're getting opinions from people, brokers and friends and family, and some of the gurus on TV or get advice from professionals. I'm a certified financial planner, or it might be from a stockbroker, or what other type of professional is out there. But you have to realize that each one of those people, they've got a reason for what they do. So the newspaper is trying to sell newspapers, and those publications, they write articles, and they're trying to get the news out there and get people to buy and to subscribe to those newspapers. The information itself, when you think about the printing process, the news happens today and it's printed and on the doorstep the next day. Now that used to be great in the 1800s, but today that's behind the news. Most people don't get the newspaper anymore. So we watch TV. And we watch TV and we listen to people like you can see on the screen right here, and political professionals who are telling us what to do. Now, I love Geithner's hands right there where he's saying, shh, don't tell them what's going on for real. But the reality is, by the time we hear the news, it's what they wanted us to hear and when they wanted us to hear it. You're not the first one to get the news, and you're not discovering something new and magical because you got some newsletter in the mail either. So we just have to understand that when the politicians and when the leaders of our world tell us what's going on, like, don't worry, everything is fine with Fannie Mae, the stock itself is terrific, well, they may not have a clue, or they may be trying to misinform or give disinformation, so we have to be careful what our news sources are. In addition to that, there's entertainment shows, and we've all seen them before. We've got celebrities out there, the Jim Cramers of the world and the Susie Ormans of the world. Now, Cool Trade even has a way that you can use Jim Cramer's suggestions in his newsletter if you subscribe to connect directly in. It's integrated within Cool Trade as a choice. So it is what it is. It's an entertainment show, and he'll be the first one to tell you that, because when the market was tanking and he was telling people everything is okay, everything's okay, he was the first one on Jon Stewart to come out and say, you know what, it's entertainment. That's what my show is. Now, as a hedge fund manager, as an investor, I'm sure he was doing things very differently than what he was talking about on TV. And then there's the other types, and I love this commercial, this series of commercials with the E-Trade baby, and it's just so fun to watch, and it's so true. What they're really trying to tell you is that this is simple. Even an infant can do this. So you feel kind of bad if you're not doing it yourself, yet you log in and you feel a little bit lost. And that's why you have Cool Trade. Cool Trade is giving you the confidence to know that you do know what you're doing. We're training you the terms and the terminology, and now you have the confidence to know that when the market moves in a direction where we can lock in profit, Cool Trade is going to do its thing. It's going to take the money off the table so that, yes, even a child can use it, but we want you to understand that and get way, way beyond that. So again, part of that market mentality that people have commonly is they don't have any predetermined risk management. They simply buy and hold, and they watch it go up and they watch it go down, and they haven't determined where their risk management should be. Unfortunately, what typically happens is the emotions take over, and as the stock position moves down farther and farther and farther, at some point the pain becomes so great that they just sell. And when they sell, that's typically at the absolute bottom. And then they watch it go up and up and up. And you know what? Very interestingly, there were people that sold in March of 2009 at the absolute market bottom. They were just so disgusted with it, they just sold everything and went to cash. And their money's been sitting in a money market account earning next to nothing, 0.5%, 1%. And now they're in 2013, 4 years later, and they're saying, wow, the Dow's hitting an all-time high of 15,000 right now. Maybe it's time for me to get back in. So they sold at the low and they're about to buy at the high, and that's what most people do in the market. Now that's not you as a Cool Trade, you own Cool Trade. You understand it's not where we get in, it's simply knowing what to do when we're there. So we're going to show you this whole concept to make sure. And the other thing that people do is they simply buy their whole position. So if they say, I'm going to buy 100 shares of this stock or 1,000 shares of this stock, they buy it all at once day one. So that's really what people do in a common market mentality. And some people have heard of the term of dollar cost averaging, and I'm going to go through this to make sure we understand what this really means. But this is where somebody might be investing in their retirement account and they say, put $100 a month every month on the first of the month into the market. Whatever number of shares it buys is what I'll take, so they're averaging out. That's called dollar cost averaging. That may work in your favor, may not. Let's look at this chart so we can understand the difference between what I just described. Buy and hold, investing everything you've got on day one. On the chart, if someone had $6,000 they wanted to invest, they could buy 600 shares of this stock at $10 a share. So day one, they bought it. $6,000, they own 600 shares. And now you can see from the chart, the second month, the stock drops to $9. They're starting to say, it's okay, it'll come right back. Now it's down to $8, and they're thinking, oh my goodness, did I make a mistake? Then the stock goes back up to $10, and they're like, nope, see that? I was smart. And then it goes to $11. Now they're telling all their friends about the stock they bought because now they're up. And then it's back to $10 6 months later, and they're back to even. So they paid $6,000 for it. They went on a roller coaster ride, and they're right back to the same $6,000. They didn't make any money. They didn't take any profits. They paid $10 a share. That's what it's worth, and that's what they own. Now, when we think about that, dollar cost averaging, we've heard that term before. It's simply the difference between, instead of putting all your money in at the beginning, let's just say we did $1,000 a month. And what does that look like? Well, in the very first month, we're going to buy $1,000 worth of the stock. At $10 a share, that would buy you 100 shares of the stock. The second month, the price dropped to $9, which means the same $1,000 buys you more stock. It buys you 111 shares. On the third month, it dropped all the way to $8, but it's okay. We're still going to invest the same $1,000, which means we bought 125 shares that month. And then in the fourth month, it went back up to 10. We put another $1,000 in, so we have another 100 shares. And on the fifth month, the stock is at 11, so our $1,000 only buys 91 shares this time. And then on the final month, we're back to 10. Our $1,000 buys 100 shares. So when you add that all up, what does it look like? It's the same $6,000, but we dollar cost average $1,000 a month for 6 months. If we did it that way, instead of owning 600 shares, we now own 627 shares. So we're better. If we sold, and that's a big if you sold at that time at $10 a share, that's 6,270. That extra 27 shares at $10 a share is your profit, if you sold at that point. And that's a big if, because the reality is people are just going to hold on and keep doing more of it. If they have the discipline, if they've got the financial, they're going to go ahead and put another $1,000 in on month 7 and 8 and 9 and so on. So this dollar cost averaging concept, I just showed it to you in a graphical form. So now let me show you the difference between what people typically do and what Cool Trade does for you. In this example right here, we're going to look at 3 different stocks, and if you've seen this on the Cool Trade website, it's very neat to see it in graphical form. Maybe you've seen the totals, but seeing the chart really helps you understand this. Most people simply buy and hold. And in this chart right here, we're going to compare buying and holding Microsoft to using a very simple dollar up, dollar down strategy in a simple template that is already built into Cool Trade, so you can use this yourself and go ahead and do it in a simulated mode so you can show it to yourself, prove it to yourself, gain the confidence before you do it with your real money. But I just want you to go ahead and see. It'll do the little back testing for you. This is a very neat formula. Dollar up, dollar down. Let's see the difference. When you look at the chart on the left-hand side, back in March of 2008, Microsoft stock was trading at $29.14. It moved down, it moved up and down and up and down, and 5 years later, Microsoft stock is trading at $28.25, March of 2013. So in the 5 years, what does that mean? Your stock moved and you did lose money. So matter of fact, if you just bought and held the stock, you actually lost about $89 on your 100 shares. If we purchased 100 shares and we own 100 shares, you lost $89 if you sold it 5 years later. Not fun. Now I know what some of you are thinking, but a stock like Microsoft, Gene, it pays dividends. Remember, you learned that in Stock Market 101 at Cool Trade University, where a dividend is the profit that a company makes and it distributes it to their shareholders. You own a little piece of the company. During the course of these 5 years, I did the calculation, this 100 shares of Microsoft would have paid you about $300 in dividends. So during the course of the 5 years, you made $300 in dividends, but the actual stock lost $89. Let's round it off. You made a little bit over $200 in profit. But if you had done the simple dollar up, dollar down strategy, and I say you, if you had Cool Trade do it for you, during the course of that same 5 years, Cool Trade would have done 50 trades and you would have made $4,586 and change. So I'd rather make $4,500 than making $200 any day of the week. Let me read into this a little bit more. 50 trades. Some of you are saying, Gene, that's too many. I'm not an active trader. Keep in mind, you're not even pressing the button each time, 50 times. Cool Trade is doing it for you. You can be asleep, go play golf, go on a vacation, go wherever it is you want, do whatever it is you want to do. Cool Trade did 50 trades for you. Now that's 50 trades in 5 years, so that's 10 trades a year. That's less than 1 trade a month. So that's not hard, but you physically wouldn't do it yourself. You're not disciplined to do it. Cool Trade as a robotic trader is programmed to do exactly that. Dollar up, sell it. Dollar down, buy it back. Dollar up, dollar down, same strategy, $4,500 in profit versus buying and holding for a loss. Now it's not just Microsoft. Let's go through another example, same thing, but this is Halliburton. So now we're into defense, right? It's a different sector of the market. We talked about sectors in Stock Market 101 at Cool Trade University. So here we go, same dates, March of 08, Halliburton was trading at $37.45. 5 years later, $39.36. So in this case, you actually made a profit. You made $191 in profit on your 100 shares of stock. Woohoo! Well, if you had Cool Trade, and if you don't, get it. If you had Cool Trade, it would have done 155 trades for you, just this one strategy, dollar up, dollar down, and you would have booked almost $20,000 in profit. As a matter of fact, $19,749 and change to be exact. Now, $200 is okay, $20,000, a whole lot better. Now notice it did 155 trades this time. Again, you're not doing it, Cool Trade is doing it for you. 5 years, 155 trades is what, 30 trades a year? 31 trades to be exact. That's about 2-3 trades a month. Still not heavy active trading, but it doesn't matter where you are, Cool Trade did it for you. So if you like what you see, let me just give you one more to make sure this really drives home. It's not just technology, it's not just defense. Let's go to financials. Jpmorgan, another stock. They all look pretty much the same, don't they? Here it is on the left, March of 08, $42.71. 5 years later, after ups and downs, $49.21. If you bought it and held it, your 100 shares made a $650 profit. Good for you. But if you had Cool Trade, it booked you $14,346. Guys, that's all about robotic trading. You are not going to do it. You're not going to give up your day job to sit in front of the computer to do this. That's why you have Cool Trade. Cool Trade does this for you. It locks in the profit. Now, if you did 50 cents up and 50 cents down, you probably would have made a whole lot more. Just using a simple template that's built right in as a demonstration. And always do it in simulation mode first so that you really gain confidence in how this works.